I'm Jay Taylor. I'm the editor of Jay Taylor's Gold, Energy, and Tech Stocks. And I'm also the host of a radio show called Turning Hard Times into Good Times that airs live on the internet every Tuesday at 12 o'clock Pacific time till 1 o'clock. And we have a lot of very interesting guests, a lot of people, economists and people who look at the markets very closely, and some good analysts on there, as well as some of the company sponsors come on from time to time also to talk about their stories. We are providing a 50% discount on our newsletter for attendees here at the conference. You can sign up out at the desk. I think you have something that was given to you when you came in. Just fill that out and send it in to the Metals Investor Forum, and we'll give you the break. I've titled my talk 2018, A Year of Epic Market Disruptions, ? Let's see if I know how this works. This is a new one here. Here we go. No? There we go. Okay. So the outline of my talk. The reason I think 2018 is potentially a very dangerous and opportunistic year, too, are several factors. First of all, I believe we're at this stage of the credit cycle in which banks start to actually lend the money that was pumped into the system. And that usually bodes well for commodities, not so well for bonds, not so well for the dollar, I believe, for debt and the dollar, and not so well, maybe, for equities. That's to be determined. Equities, under some circumstances during periods of inflation, which I think is what we may be facing, do quite well, and sometimes they don't. Anyway, the point I'd like to make going back to this is not a normal credit cycle that we have. As you're well aware, the 2008-2009 financial crisis caused the Fed to dump huge amounts of money, unprecedented amounts of money, into the system. This is high-powered money that's still at the Fed. The Fed is trying to pull it back now, but it has a difficult time doing it because of the enormous amount of debt. Raising interest rates are going to be very, very difficult to deal with. And the third reason I think 2018 is going to be maybe a very, very important year is that there are some major political changes, geopolitical changes, that are not kind to the United States and to the dollar, potentially. I'll talk about those in a minute or two. But this chart just shows the massive amount of money creation. At the bottom there you see there was a small amount that was some 800 billion, I believe, something like that, dollars that were created when Nixon took us off the gold standard. That was the Federal Reserve monetary base. Now we got up to the kind of numbers you're seeing there now, at just enormous $4 trillion at one point in time. Massive amounts of high-powered money that's sitting in the system. At a certain point in time in a credit cycle, after the central banks dump huge amounts of money into the system, the economy starts to improve a little bit, and then interest rates start to rise. And the banks who are sitting with all these treasuries find that they have to get rid of those treasuries or they're going to start losing money. Rates rise, treasury values go down. And at the same time, the economy is getting a little better, so people banks feel a little more confident about lending. And as a former banker, I can tell you, I've been through this. When other banks lend, you don't want to be left behind. So you have this competitive need to get money out the door to lend. And as the process continues, bankers become less and less concerned about the quality of the companies they're lending to. And then we go through the cycle again. So I think that's where we're at right now. But again, this is not a normal cycle. This is the 10-year Treasury yields. It shows that 4% was sort of a line in the sand until 2008, 2009. Then we go down to ridiculously low levels of 1% or 2%, less than that even, for 10-year Treasuries. The correlation with the money creation, where has all the money gone? Well, it goes into treasuries. The Fed creates money mysteriously out of thin air. It goes into the banking system. It goes into the banks buy treasuries. It drives the interest rates down. And then there's all this money sloshing around. Of course, the interest rates go down. Great for the stock market. So you see the correlation between the stock market and the monetary base here since the 2008-2009 crisis. So the redistribution of wealth in America has come because of the Federal Reserve. Elizabeth Warren doesn't have the answer. It's not socialism. It's not tax the rich and give to the poor. It's a matter of having a fair unit of currency, a currency that you earn, not that you create, not that some people can create out of thin air and give it to their friends, and the rich get richer and the poor get poorer. That's what's been going on. As we get into one of these cycles, the optimism grows, and we're seeing an index of optimism now from the American people, so it's pretty high. I put something together called my inflation deflation watch, and this was just it's a composite of global stocks, different stock sectors, and key commodities like oil and copper. Silver is in there as well, and the Rogers Raw Material Index. This was started in 2005, January 31st, 2005. I believe we're in the process now of breaking out into some new inflationary levels. I think it's a breakout, possibly, that must have and will most likely have the Federal Reserve squirming as we get into this year. But notice the composite, if you can read it from where you are. Most everything has gained in value since January 31st, 2005, except the Rogers Raw Material Index. And so commodities have lagged tremendously, while financial assets have really surged. Another thing that happens when you get into the more confidence as the cycle starts to improve, people start to feel more confident and they start to spend more freely. So the money velocity starts to increase. One of the reasons the central bank could pump so much money into the system and not have inflation or serious inflation problems other than in the stock market was that people were holding on to their money. They weren't spending. But we're starting to see that the top chart there is a long-term velocity. It shows the velocity of money. The willingness for people to spend and not just hang on to their dollars has been in a sharp decline in recent years, especially since 2008, 2009. Now we're starting to see an uptick, which suggests also that we're moving more into the GDP is growing as well. I think the other slide I noted that as well. And so people are feeling better, but something is really strange happening to the dollar now. It's, I think, very important to realize that normally when the Fed starts a cycle, when it starts to raise interest rates in the cycle, the dollar gets stronger. And yet, last year with the Fed starting to raise, it raised interest rates percentage-wise from where they were before a lot. The dollar lost 10% of its value. Now, the last time I was here, I talked about the petrodollar and what gave value to the dollar. After Nixon took us off the gold standard, why did people still want the thing? It had no intrinsic value. Well, the Nixon administration arranged with Saudi Arabia to demand payment for their oil in dollars, and then all the OPEC countries followed. And what that means is that virtually everybody that has to import oil from these major producers had to have dollars. And so that was how the dollar was a bit under the dollar because of this geopolitical requirement. And it's been duly noted that countries that have dared to challenge the dollar quickly find themselves labeled rogue nations. Rogue nations pay a hefty price for going against the dollar. Until now, it's starting to change, and this is part of the geopolitical stuff I'm talking about. There's so many things going on geopolitically, and our news media hardly ever mentions it. They don't want us to know, apparently. But I think it was yesterday, supposedly, the Shanghai Petroleum Futures Exchange was supposed to open. Not in dollars, but in yuan. China's biggest, Saudi Arabia's biggest customer now is China, and they've made arrangements. China's demanding that they pay in yuan, and if Saudi doesn't want the yuan, they can go to the Shanghai Gold Exchange, which is a physical gold exchange, and use their yuan to buy gold. So that's what's happening. It's sort of a yuan petrodollar in the making, if you will. But Russia is involved with it. Some of the other BRIC countries. There's just a lot of things geopolitically going on all over the place. And even one of the strongest allies of the United States, I saw yesterday, Australia is suggesting they're going to have to start making some tough decisions. Do they want to remain great friends with the United States and lose their economic interest with China? This is what's happening. Very serious geopolitical things. I've just mentioned a couple of them. They're all over the board. Bloomberg run this article the other day, how China will shake up the oil futures market, the Shanghai International Energy Exchange. So, and the chart below shows that the United States is the blue line, the countries that import the most oil. So it's now China, it's not the United States. So we're hardly in a position, as strong as we were anyway, to demand that payments are made in dollars. We're seeing a reduction in the holdings of U.S. Treasuries by China. This may be part of the reason why the dollar has lost value even as interest rates are rising. Japan also is decreasing for their own reasons. I think they have reasons of financing their own aging population and so forth. But these are some of the trends. The really big one that never gets mentioned in the mainstream media in America, I don't care if it's Fox or it's somebody on the left, is this one belt, one road infrastructure that's being built by China. The new Silk Road, if you will. And you can see where it goes. And what you're doing is linking up two of the most populous countries in the world, China and India, and Russia with its vast resources, and then tapping into all those different markets. Again, if the markets are there, it's hard for countries to say, we're not going to sell to you because we don't like something about you. It's, really, people look after their own interest. Russia is, so going back to the Saudi Arabia story, if Saudi Arabia says, we don't want to accept yuan, the Chinese can say, well, okay, but Russia will, Iran will. You guys want to lose our market share? You want to lose market share to those countries? Russia just completed this pipeline and can now double its oil sales to China. The BRICS being created in large part to try to stymie the aggression of the United States with its fake dollar, with its dollar that's required of military force. Well, there you see it. I mean, Russia and China, but you've got Brazil and Russia with their resources. You've got China and India with their population and vast demand. And I think geopolitically, probably the only one that isn't really committed or is not so anti-U.S. yet would be India, probably. But there's certainly a struggle going on there, and I would guess that economics will win out ultimately. I keep track of something called the foreign central bank holdings of the United States liquidity, U.S. dollar liquidity. And you see that massive drop-off. At first it surged right before the crisis, the 2008-2009 financial crisis. What this is really, it's the United States, it's the percentage of dollars that are held by foreign central banks as opposed to what's in the United States central bank. So the percentage has dropped precipitously right after 2008, 2009 because the United States, of course, created money out of nothing, pumped it into its own system. It tried to come back a bit, but you can see where it is now. It's about 40%, when before the crisis was around 70, close to 70%. Then all these countries lost their shirt with the housing debacle and the housing fraud from the United States. And so countries obviously didn't take kindly to that. I've had Jim Rickards on my radio show frequently, a few times anyway, and he's made a big deal about the SDRs, the move towards a one currency system. And the SDRs would be a basket of currencies, and the euro, the Chinese now are part of that with 10.9%. But you can see the mix, the British pound, Japanese yen, US dollar is still the largest, but reserve currencies don't last forever. This is just a chart to show a little historical statement in that regard, maybe 100, 200 years or so. So the US hegemony is growing long in the tooth right now. In 1998, The Economist made a prediction that by 2018 that the dollar would be finished as the world's reserve currency. And well, we shall see. Yesterday was supposed to be the opening of the petroleum yuan futures market. I'm not sure. We don't get reports here in the West about it. So as I say, this is no ordinary credit cycle. The extreme monetary creation by the Fed post-2008, 2009, the petrodollar's demise, the thing, Alistair McLeod of Gold Money just wrote an article about hyperinflation. And he compared what went on in Germany prior to their hyperinflation. Most people think that it was the reparations after World War I that caused it. But what Ludwig von Mises did a study of it and found that the German government started printing money. They detached from gold, started printing more and more money before World War I. And then after they lost, of course, reparations made it all the worse. But one of the things that the parallels between what's happening in the United States is the loss of markets. Germany lost its colonies in Asia, Africa, Alsace-Lorraine to France, and large parts of Prussia. So it lost all of these markets. So there was less need for the Deutschmark at that time. Yet the German government, the Bundesbank, continued to print more and more anyway to pay for their country's needs. So I think there's a lot of the same things going on. The main thing is, if you print more and more money and there's less and less demand, what's going to happen to the currency? Economics 101, it's going to decline. The main thing is that whether we have hyperinflation or not, you should look historically at commodities. This is commodities, this is the Goldman Sachs index, commodity index, compared to the S&P ratio. And so you can see where the commodities are now from a historical point of view. Very, very undervalued. Gold, the price of gold relative to the Federal Reserve monetary base, you can see that where it is, almost historically low. All this money created, it's going into all kinds of things other than commodities and gold. There's a nominal price of gold going back to Roosevelt and then Nixon when he took detached gold from the dollar. Michael Oliver is on my show almost every week because he's just so darn good in terms of his, I've gained confidence in him because he's just right so often, not for short-term trading necessarily, but from a bigger, longer-term picture. And so he's very long on commodities, especially agricultural commodities right now. Sovereign debt, U.S. debt, sovereign debt, U.S. dollar, and U.S. stocks, he's taken short positions in. The main thing as an investor in mostly what I do is invest in exploration, gold exploration stocks. I want to know when the big decline is coming. When are we going to have a bear market? Let me know, because the upside is wonderful, and then kaboom, you lose 80% in a very short period of time. And this is sort of historical. So I wanted Michael, and I'm depending on him to a great extent to help me with this. He called recently he called the bull market in 2016. But what's more remarkable, when he got us back into gold in 2016, he called the bear market, I should say, in 2012, I believe it was. But he got it right. Not exactly at the top, but in good timing. And then the main thing is this year, several times gold has taken a fall and it's gotten us a little bit nervous. He drew a line in the sand and said, if it goes below a certain point, I'll turn neutral. I'm still bullish because my long-term indicators say gold's in a bull market. But if it goes below a certain level, I'm going to turn neutral. Well, the last one, it came within 20 cents of his line in the sand, and it's now onward and upward. He's done extremely well, which sets the table now for the next part of this segment. Just a brief introduction of the companies that will be presented to you in a few minutes, all of which are in my newsletter and I own shares in. New Range Gold Corp, that's a really exciting story along the Walker Lane, northern end of the Walker Lane trend in Nevada. Some very spectacular high-grade intercepts recently reported and some samples from surface. A lot of mom-and-pop mines over the last century or so now pulled together under this one company's roof. So Robert Carrington will tell you about that in a few minutes. Rockhaven Resources in the Northwest Territory, or in the Yukon, the Claza deposit, the Claza project, a gold, silver, lead, zinc project, did a PEA on it a few years ago, but this year's drill results are suggesting probably more early stage near surface open pit mining should improve the economics very dramatically, but he'll explain that to you in a few minutes. Also, the prices of the metals are much higher than when the PEA was done, so it's really looking quite good. Skeena Resources is the newest company on my list that's up here. They are really looking at the Snip mine, the old Snip mine, Ron Nadoletsky's discovery many years ago, and some really exciting news coming out of there, some great assays coming out just recently. But they recently also picked up another very interesting project that was a Barrick project as well, SK Creek. And I know we're going to hear about that in a few minutes. It's a really exciting story. RN Resources, with their history, the management has had 2 previous successes. This time they have more projects than they had before, really looking for large-scale targets. Goldcorp put 35 million into them last year. A couple of major things in Canada, some things in Peru, means this year we'll have news flow throughout the whole year for RN Resources. I'm really looking forward to that. Northern Empire Resources, well, this is also one of the newer ones on my list. They're at the southern end of the Walker Trend in Nevada, and they have a very high-grade oxide deposit. They actually have all the permits to go into production for that. But they're finding some really high-grade stuff and also Carlin-style mineralization. They completely surround the Corvus property, that the Motherlode property that's has recently given Corvus a little boost. And so I think this is a really undervalued, exciting story as well. And 000, my time is up. So thank you very much. It's jtaylormedia.com for my radio show, miningstocks.com for my newsletter, or you can go to get the 50% discount here that's offered through Metals Investor Forum. Thank you very much for your time.